Hello again, and let's wrap up with segment 3 on Unit 8, Farm Business, Organization, and Transfer. And let's jump into limited liability companies. And very similar to a partnership, it has the advantage of limited liability. You're going to go through some of the same paperwork type of approach with corporations, though not quite as detailed and not quite as expensive. But you also have some of the similar type features that a corporation has. So when you set up your LLC, um, you can purchase assets of LLC, but not the personal assets. So again, that's why they name it a limited liability. As a creditor or a legal entity that wants to come after you cannot get to your personal assets. You have that same protection that you had with the corporation. Um, you can have any number of investors that can participate in management if they so choose, or they could have a non-management role. So it's basically distributed. The ownership is distributed by value of the assets that you contribute, and the net farm income is paid by proportion of ownership in the LLC. That's how things are divided up, and you would want to define that in your operating agreement. The deduction for fringe benefits, though, that's not possible here, and it doesn't automatically continue in the case of a partner's death. So again, something that you would want to define in your agreement to form that LLC is what happens in that transitional period. And while these are the newest of these type of agreements, some of the guidelines still a little bit untested, but again, I would advise you seeking a little bit of legal advice in order to form this effectively. So LLCs are growing, and actually you find what occasions where you have a general umbrella LLC of an operating farm or farm business, and then some subset LLCs underneath those. And the other kind of really interesting part of an LLC is you can choose to be taxed as an S Corp. So it gives you some of the corporate tax advantages also when you talk about taxation and limiting the amount of tax that you have to pay. So again, that'll be a little bit driven home more effectively in the supplemental video that will be posted in this module as well, that I highly encourage you to watch. It's not necessarily an agricultural video, but it goes through how things are taxed and how taxes are divided up and how the government sees a dollar. And it's really interesting how the guest speaker that I'll have on there breaks those things apart for you. Real quickly, let's hit on cooperatives. And cooperatives are designed as a means of obtaining goods and services for marketing those products jointly. You'll not find too many farm businesses that operate in this way, but obviously you find a lot of ag retail setups that operate as cooperatives. So it's an interesting, different type of relationship and somewhat of a special type of corporation. And oftentimes they'll pay, and your book states, a minimum of 8% annually back to their shareholders. And there's a number of ways that can be returned when we talk about patronage, whether it's ownership stake or an actual check. So each member really only has one vote, and it's not really proportional to stock value. So the key is when you form a cooperative is the farmers must want to work together. That's how they were originally intended, is kind of a group of farmers to get together and they buy inputs such as seed, feed, and fertilizer together. And then they all put their grain together and merchandise it that way and try and take advantage of some economics of scale that each individually wouldn't do that way. And even though you see many of the retail locations operate as cooperatives, it would be very difficult to find some of the actual cooperative things with cooperative characteristics in their business. They operate oftentimes more like corporations. All right, let's move on and talk about transferring the farm business, and really a touchy subject to get on because we have one existing operator coincides with the entry of another operator, and the transfer, can be very simple if you really have a plan in order to do that. You could sell or lease the livestock and equipment to the new operator. That's a clean way to do it, but it is also maybe the most taxing way to do it. The land could be sold outright. It could be sold on contract or just rented. Again, there's a lot of different methods to go about transferring that farm business and the assets to go with it. But you have to be really careful about how you approach this in order to minimize your tax exposure here. Lots of times in family farming operations, you have the next generation ready to enter the business long before the prior generation is ready to leave. And so there's an overlap that occurs there for some period of time where you may enter into a partnership or a corporation or an LLC in order to make that transitional period while you're working together prior to the sunsetting of someone's career on the farm. You have to be able to operate for that period of time. So occasionally you'll see kind of the farm move from entity to entity. So things to consider. Number one, is the business large enough and have enough productivity to employ another person and their family? So those of you who are considering going back to the farm, is really do some soul searching. Does that farm have the capability to support another household? And if they don't, how are they going to get there? Is it profitable enough to support another household? And if they don't, how are you going to get there? And can and will the management responsibilities be shared, and how? And is someone willing to define that? Is the conversation going to be willingly had on how decisions get made and who gets to make them? And how much influence does the new party coming in have on those decision-making responsibilities? So those are really critical questions to answer when you talk about coming into the farm business and the eventual transfer. Some key things to consider is, of course, maybe income. You could pay the new operator a wage, a living wage, and maybe provide some bonus or profit sharing. And as the new operator acquires more assets, they can be required to return on those investment payments of buying out the assets that are there. You can gradually let them acquire property or ownership and sell on contract or outright purchase some of the assets of the farm business. Or you could, within the tax requirements and limitations, gift some of that properly. And you have to follow those guidelines carefully, or you'll get yourself in a pickle. Lastly is management. You can slowly transfer the management and the decision-making capability from one generation to the next. And that allows an operator to kind of learn parts of the business slowly and maybe break into things that they're good at, and then slowly learn items of the business that they need more training on. But again, that takes delicate and careful planning and how to do that appropriately. So when we talk about stages, you can break this into stages if you so choose, and maybe a testing stage of a few years where the new operator enters slowly, kind of gets paid a salary or maybe an incentive package, maybe buys and rents some of the assets. Again, it all depends on how you want to put together the agreement to approach this. You can then spin it off to where it's a separate owner and own operations. Maybe they want to be, maybe it just doesn't work out. And so the new generation coming in decides to just spin off and go on their own. And you divide up what was there financially and operationally and just go about your separate ways. Or the older generation phases out and we have a takeover situation where we transfer by sales or rent to the younger generation coming in and develop a detailed budget and a plan for that to happen. Or maybe a joint operation where both parties want to continue. And so again, you may need reorganization or expansion in order to do that joint operation. So you can have a number of those things, and this is just a flow chart that your textbook comes up with in terms of transferring that farm business. That wraps up all the slides that I have here, but I cannot reiterate enough. There's lots of legal help out there to determining how to go through transferring and what we call farm business planning, transferring that farm business from one generation to the next, or from one owner to a new owner. Maybe you have an employee that's worked for you for 25 or 30 years and wants to buy into the business, and they don't have a farm that they could inherit from someone. But I'm telling you, it's very, very critical that you have a specific game plan, have it written, make sure everybody understands what the game plan is. That way, as you migrate into putting that plan into action, everybody understands what's going to occur. Everyone is clear on your tax implications, because there can be some significant barriers when it comes to taxation that can sometimes force your hand into decisions that you don't want to make. So I encourage you to study this topic very, very carefully. And these are difficult conversations to have occasionally within families and farms, because it can be difficult, strikes a tender chord in terms of how you're going to go from transitioning one party in and one party out. So please do your homework and do your reading. There's scads of information out there that can help you guide into the right type of agreement. That concludes our third segment video of Unit 8 here. We'll look forward to doing some activities to kind of further dive into this particular concept. Thanks for tuning in.